Options income trading is not that difficult to learn and actually has a much higher win rate than almost any other form of trading. I'm the head trader of SMB Capital's options trading desk here in New York City, and I can tell you from experience that while it's great that options income trading has a very high win rate, there's actually a danger to the win rate in a trading practice being too high. Now, I know that may sound counterintuitive, but it's actually a very important principle to understand, so stick around because there's some really important lessons in this video that will save you a lot of money and frustration in your trading journey if you take them seriously and internalize them. Hi, I'm Seth Freudberg. I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so a few years back, I was in a mentoring session with one of the top traders on our trading desk, who's a very bright and successful guy. In fact, he's a very senior manager for the U.S. operations of a manufacturing concern in New England. All the guys on our trading desk have full-time professions, yet they're still able to successfully trade for our desk remotely because of their intelligence, their skill, experience, and trading styles. One of the reasons that this guy is so successful is that he uses every opportunity he can to learn and grow professionally. And this applies just as much to trading as it does to everything else in his life. So he and I were just finishing up a series of one-on-one mentoring sessions some time ago. And at the end of the second to last session, he made a special request that in the final session, I basically provide him with a brain dump of the most important lessons that I had learned during my personal trading journey. That turned out to be an incredibly interesting exercise, and so I'm here today to share with you the answers that I prepared for him based on my own experiences. Some great, others painful, but I was determined to steer him clear of many of the mistakes that I had made early on so that he could grow to be successful quickly and avoid the pitfalls that many other traders fall into. I think it's really important that you watch this entire video if you're serious about becoming a professional trader. This video is about the real issues that professional traders face, and I can almost guarantee you that during your journey as a professional trader, you will face each and every one of these issues, and you will get through them a lot more successfully if you take good notes and believe what I'm telling you here. This is the real deal and the really crucial issues that you've got to internalize to be successful. All right, so the first lesson, this critical lesson in my session with this mentoring student was the question of this feeling of invincibility that traders get at one point or another when they've been trading successfully, when they're on a winning streak of some sort. Now, Warren Buffett said, get scared when other people are greedy and get greedy when other people are scared. Now, what does that mean? What that means is when other people are driving up the prices of stocks to ridiculously and undefensible levels, then it is a very bad idea to start buying stocks at that point. On the other hand, when everyone is running from stocks, terrified, dumping them in droves, those are usually when there are some really great values. All right? Well, when you start feeling invincible, when you start going into what I call irrational exuberance, those are the times that you should get very scared and you should be very cautious. Now, during these times when you have been on a winning streak, the last thing you want to do is increase your capital at that point. Why? Options income trades are statistical in nature. There's going to be a certain number of wins a year and a certain number of losses in a year. Many more wins generally than losses. So if you're on a winning streak and you increase your capital, as you continue to have win after win after win, you're just that much closer to the inevitable losing month. Okay? So therefore, for you to increase your capital as you're winning will basically lead to disaster. And so you should never increase your capital because of a winning streak. You should increase your capital because over time your strategy has been successful, but any one given winning streak shouldn't get you irrationally exuberant. I had a student who referred to a particular strategy I had taught him as an ATM machine. Why did he call it an ATM machine? Because he happened to have won it 3 months in a row. Well, this is a strategy that's going to win 9 months out of the year. So what did he do? He increased his capital at the end of the 3rd month, and one of the predictable losing months then followed when he was in a maximum capital situation. So you can't assume because of a winning streak that that winning streak will occur forever. It's a ridiculous concept. And if you double or triple your capital, and I've seen much, much worse than that, after basically a short, predictable winning streak, you're going to come to regret that. And so no options trading style is an ATM machine. Please get that concept out of your mind. If it was true, everyone would quit their job and start doing that strategy. It's not that simple. All right? If you get cocky after a winning streak, it's really, really dangerous. And I've been there personally. I will tell you with some shame that when I first started trading, after a winning streak of 6 months on a particular strategy, I quadrupled my capital, quadrupled it. And what happened? You all know the answer to that question. The month I quadrupled it, I got killed on the strategy, giving back almost everything I had made. Had I just left my capital level, as would be a sane and intelligent thing to do, it would have been a small dent in an otherwise great year. Instead, I had a return year that was abnormally low because I was foolish with my capital. If you increase your capital after every win in options income trading, you will end up giving back everything you made because these are statistical trades and there's going to be a certain number of losses predictably occurring in every year. So when you start feeling invincible, get very, very scared. Now, the second point we discussed that day was the following reality. Trading large amounts of capital is different than trading small amounts of capital. Now, let me draw this point out for you and give you a very specific example. Let's say you've got a trading strategy where you allow yourself to get down 10% on the trade before you exit. All right, let's say that's your stop on the trade is 10%. So if you're trading a $10,000 account and this strategy takes up all of your capital, then you will have a $1,000 stop on the trade. All right. Well, if you have much more net worth than $10,000, then a $1,000 loss is probably something you can handle emotionally, and certainly you can handle it financially. All right. When you start trading firm capital, if we give you $1 million, for example, or $100,000, for example, and now you have the same exact strategy with the same components to it, the same risk-reward characteristics, and a 10% stop, you will get to $9,000 and still be in the trade. You'll be down $9,000 and still be in that trade. If you've been used to only getting out of trades at a $1,000 loss, and now you're at $9,000 and you're still in the trade, a lot of traders can't handle that because they are not used to those kinds of dollars yet. Risk tolerance is a muscle that has to be built. So you cannot dramatically increase the amount of capital that you are trading all at once. You will freak out. And when you freak out at the size of your drawdown, even though it's completely normal for that strategy, given the size you're trading, you will get out of the trade early and most likely have denied yourself the possibility of a win. Instead, you've locked in a unacceptably large loss given the fact that you should have won on that trade. All right? So trading large amounts of capital is not the same as trading small amounts of capital emotionally. Psychologically, it's a very different process, and so you have to build up to that point. Traders get more nervous, and this is an ironic point, trading our capital than their own capital. There are a lot of psychological reasons for that. You're being watched, you have a need for approval, you don't want to be seen to be failing in front of others. There's lots of reasons for why you get more nervous trading other people's capital than your own, ironically, but nonetheless, that is a reality. So there is a difference between trading your own capital in small amounts and trading firm capital in large amounts. If your strategy ain't broke, don't fix it. Let's think about it. Why did we hire you in the first place? The major reason we hire traders is because they've successfully been trading a particular strategy for some period of time. Why would we want them to change their trading style when they come trading for us? That is the last thing we want them to do. We want them to continue that and simply do it with not only their own capital, but our capital also, all right? If the strategy's not broke, don't fix it. That is a tendency to avoid when you start trading for a firm such as ourselves, which will supply you capital. We want you to continue trading in that style, which means you're going to have larger dollar drawdowns, but from a percentage standpoint, you will stay within your disciplines and most likely continue to experience the same success as long as you stay within your trading style. But if you panic out of trades because the dollar amounts are much larger than you're used to, then you're hurting yourself and you're hurting the firm also. Execution is also different with larger amounts of capital. For example, let's say you have a 10-lot iron condor on, all right? To close that, you'll most likely get filled all at once. Someone will come in and boom, take you out of that trade. If you have a 500 lot, you're not necessarily going to get filled right away. You're more likely going to get piecemealed out. You'll get filled slowly. You may have to change the price to make it a little bit more attractive to the market to get out of that trade. So large amounts of capital trade differently, both psychologically and technically, than small amounts of capital. So you've got to understand that whether you'll be increasing your own capital level or increasing someone else's capital level, such as a proprietary trading firm like ourselves. Before we move ahead to the next point, which is an extremely critical point that I really wish someone had told me before I started trading options, I wanted to mention that we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching 3 real-world option strategies that professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you could just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Now, the third really important point you need to understand, and what I discussed with this mentoring student that day, was that backtesting a strategy is not the same as live trading. What is backtesting? Backtesting is a technical simulation of that strategy, as though a robot were doing it. Well, guess what? You're not a robot. You're a human being, and you have emotions. And so a backtest is not an emotional simulation. It's only a technical simulation. How are you going to turn it into an emotional reality? You got to trade live capital. It's no way around it. So, assuming that a backtest is going to come out exactly the same as reality is a foolish assumption, because everyone has emotion. So you have to take that into consideration when you're contemplating trading a strategy. Furthermore, when you're trading, there are certain issues that you may not pick up on in backtesting. For example, slippage. What is slippage? It's where you can't get the market to agree to accept the mid price between the bid and the ask. All right, you're going to have to pay a little more for debits or accept a little less for credits in order to get it done. That's what slippage is called. That may not have been reflected in your backtesting. Secondly, and this is the real world, you're going to have execution errors. You're going to set the trade up wrong. You're going to buy 100 shares instead of 10 shares if you were day trading, or buy 100 credit spreads, 100 debit spreads instead of 10 debit spreads. All right, these things are going to happen, especially when you're starting. All right, execution errors, you're not making any execution errors in your backtest, right? But you make them live. That's the real world. These things happen. Another thing that happens is when you start trading capital for a proprietary trading firm or even just increase capital for yourself, you start finding yourself locking in trading profits because the profit numbers start getting large, but they're not really large relative to the amount of capital you're trading because you're trading much more. So what you end up doing is cutting your wins short when you should be allowing those wins to continue to turn into profit and increase their profits over time, which then creates that bank, I call it, or buffer for the inevitable losing trades. All right? You've got to still come out with a great return net of the losing trades. Well, if you keep cutting your winning trades short, you're not going to have enough in the bank for an absorption of the losing trades and still get the great returns that you're expecting. All right? So these are all things that happen when you trade live. There's a mixture of technical and emotional issues that come into play that make your backtest different than what's going to happen in reality. Controlling emotions is the major determinant of success in any trading style. Please trust me on this. If you learn how to get your emotions under control, it's 50% of the battle at least. At least. It's probably more than that. And so you have to learn how to do that. Now, there are various ways. We could do a whole video on that subject. But you can do mindfulness training. You can do visualizations, which is taught here at SMB. Breathing calmly in your mind through various market scenarios so that you don't overreact to them one way or the other. There are various ways to go. There are tools to use to get your emotions under control, but you've got to get your emotions under control or you can't succeed successfully as an options trader. The fourth principle I went over with this trader is the concept of consistency. Be consistent as a trader, but don't be foolishly consistent. Now, why do I say be consistent? Why you have come trading for us in the first place, why we have invited you to trade for us in the first place, or why you are successful using your own capital, is because you have found a strategy, a core strategy, which has been successful for you repeatedly over a long period of time. All right? So if the basis of your trading is a solid strategy, why are you going to deviate from that? Right? Why would you deviate from something that is working well? All right? So you plan your trade. For God's sakes, trade your plan, as the old expression goes. Plan your trade and then trade your plan. If you do that repeatedly over time for proven successful strategies, you should continue to have success. If you bail out on a good system because you backtested it for 5 years, it looks great, the first month was a loser, and you give up on the strategy, does that make the slightest bit of sense? You know that over that 60-month period that you tested it, you had 20% of the time losses. The fact that that loss occurred in the first month you traded it live is irrelevant to the long-term success of that strategy. It's basically irrelevant, all right? So if you give up on a strategy because you just had a little bit of bad luck in your first month and it was not successful in that first month, then you are an immature trader and you should get mature and understand that when you lose on a back test and you trade it live, you're going to lose live too. When you win on a back test, you're going to win live too. But the losses are real and the wins are real. All right? It's real money. And so you have to understand when you make that transition from a back test into live that you're going to have to adjust to the fact that this is now real money. On the other hand, you don't want to be foolishly consistent. Foolish consistency is the hobgoblin of small minds, as the expression goes. What does that mean? It means it's good to be consistent, but if you're consistent when it's ridiculous to not alter your thinking at all, then you have a small mind. All right? So what do you want to do? And let me give you a good example. Let's say the market, you're up 9% on a trade where your target is 10%. And the next day, there's going to be a major announcement, like a big vote on Brexit, or a highly anticipated FOMC meeting, or a major jobs report, or something that has become extremely serious. And the whole market knows it, and the whole market is waiting for the answer to that issue. All right? Under those circumstances, you're up 9% on the trade. You know there's going to be a big move the next day of some sort or another because of the big decision that's being made. All right? Get out of the trade. You don't need to squeeze out that extra 1% when you're almost certain to be struggling to get back to that 9% because of the event that's happening the next day. That's the kind of thing that is foolish consistency. You're up a great deal of money on the trade. Don't expose it to a large event when you know it's going to cause a struggle. The next issue I discussed was a subtle one psychologically, and that is many times if you're stressed out in the middle of a trade, you'll do something to make you feel better. Feel better means you do something to cut the risk of the trade down so that you're not so scared. Okay? Well, there's a problem with this, and the problem is if your system works, fear should not be the decision-making factor. Fear should not drive your behavior. If fear is driving your trading decisions, you cannot be a successful trader long term. You've got to have faith in your system and see it through without fear. There was a famous book written about trading called The Way of the Turtle by Curtis Faith. It's a great book. In the first couple chapters, he talks about this opportunity he got to work for a prop firm. And what they told him was, you're all asked to simply trade the way we're teaching you. We don't care if you lose money or make money on any given trade, any given week even. We just want you to follow the system that we're teaching you. If you do that, you'll remain employed here. If you don't do it, you will not remain employed here. He was amazed at the fact that the majority of the traders on that trading desk, despite that assurance, could not trade the way they were being taught to trade. They varied it because of emotion, all right? And because of that, long term, they were going to be unsuccessful. Whereas if they simply followed wise trading advice, they would have been successful. It's a great book. You should read about that experience and internalize that. One of the many reasons people alter from their strategies is because they're trying to preserve minor profits. Many trades will go up 1% and then down 3% and then up 4% and then down 2% till they finally end up 10%. But if in any of the minor up cycles you got out of the trade, you'd be sacrificing large amounts of return for the year. You don't want to do that. You've got to build your bank, as I was talking about before, so that when you do inevitably get drawn down to some extent, you'll have plenty left in the bank for a great return for that year. And the worst thing you can do is panic out of a trade. With options particularly, that guarantees the worst possible execution. If everyone is running to get out of the trade at the same time, you're going to get the worst possible price for whatever you're selling, okay? you will most likely get the worst outcome by panicking. Even if the trade will be a loss of 6% if you hadn't panicked, if you panic, it'll be 10%. It's still going to be a loss, but you cost yourself, in that example, 4 points of return. So panicking out of trades never works. Even if it makes you feel better, it is not going to make your boss feel better. If you are your own boss, you're trading your own capital, your return will be worse if you panic out of trades. It's critical to not make decisions because it's going to make you feel better, but because your system supports that decision. The next point we went over is losing. Successful traders know how to lose well. Ego is a major reason that many traders fail. They simply can't accept that they're losing on a trade. They think they're great traders, so they think being a great trader means you don't lose. That's childish kindergarten thinking. You are going to lose. You must take your stop. You want to know something? At SMB, if you don't take your stop, you're not going to be working here. Why? We don't care that you lost. We care that you didn't have the discipline to follow your system. That's a capital offense at SMB, not taking your stop. Losing is not a capital offense. The greatest traders here are losing all day. Okay? Not taking your stop means you have a character flaw. You're not following your disciplines. You're not following your system. You've got to live to trade another day. You will only live to trade another day if you take your stop. All successful systems have losing periods of time. In fact, if they didn't have losing periods of time, you wouldn't be able to make any money trading. Think about it. If you sell a put, all right, the only reason someone's buying that put is because there is a fear that the stock will get down to that level. Well, guess what? Every once in a while, the stock gets down to that level, and you will lose on the put that you sold, all right? But statistically, the stock is not normally going to get down to the level of the put that you've sold in this example, and so therefore, you're going to make money on that trade most of the time, all right? The fact that you occasionally lose is why anyone would buy that put in the first place, all right? I used to be in the insurance business. For a very long time, I was the CEO of a property and casualty insurance company that went public, all right? During soft markets, which are periods where the prices drop, everyone would be hoping that there was, this sounds terrible to say, hoping that there would be some catastrophe somewhere in the world, an earthquake, a hurricane, whatever, because that has a tendency to bring insurance prices up. Why? Because people remember, oh yeah, we can have hurricanes. Oh yeah, we can have earthquakes. We better buy insurance for that. All right? Well, if you never had a hurricane and never had an earthquake, nobody would buy insurance. There wouldn't be a business. Shouldn't that prove to you that losses are the reason we're in business? The fact that we can write calls and write puts means that we are in business as options traders. And therefore, since it's the reason we're in business, occasionally we're going to have a loss. You can't get depressed about losses as long as you're staying soundly within your system and acting in a disciplined way. Losing is normal. By the way, oftentimes the best months of the year are followed by a losing month. So if you bail out of your trading strategy right after a losing month, you are often giving up the very best month of the year. So successful traders know how to lose. They know how to take a stop, they know how to handle it emotionally, and they know how to move into the next month. The next point we talked about is, in a sense, a technical point. Diversification of your strategies is very, very helpful and very important. If you trade one strategy, that gives you one set of outcomes that will be optimal for your strategy. But if you have a series of strategies that balance each other, that's the best combination. There are three things that affect options pricing: time, the price of the underlying asset that is being traded, that the option is derived from, and volatility, all right? The best portfolio of monthly strategies is a mix of trades that will respond well to varying movements in those three factors. Time diversification is the first one. If you have a series of trades that start at different times, one 60 days out from expiration, one 45 days out from expiration, one 30 days out from expiration, then you're going to catch the market at different points and you'll heighten your chance of one or more, or hopefully all, but at least some of those trades being profitable because you're catching different points, price points in the market. All right. The second type of diversification is a volatility diversification. And that means that there are certain option strategies which respond well. They respond well to reductions in volatility, and there are others that respond well to increases in volatility. The best mix of option strategies is a combination of trades that have essentially offsetting reactions, so that you always have in your mix of trades a strategy that will respond best to an increase in volatility, combined with one that responds poorly to an increase in volatility. That will help to smoothen your equity curve. Finally, price volatility. Now, in general, option strategies have a tendency to do a little worse on the downside than the upside. So there are certain strategies that really respond very well to downside moves, and other strategies that respond better to rallies or flat situations. So an ideal mix of options trading strategies is a mixture of those that respond well to big down moves and those that respond well to up moves as well. And I would say you want to lean a little bit towards the ones that respond a little bit better to the downside, because of the fact that the worst scenarios in options trading usually do occur to the downside. So you probably want to lean a little bit in that direction. And I say this in the middle of a historic bull market, but what I say has held true even through this historic bull market. The eighth thing we talked about was keep it simple. There's a kind of a trade I call an octopus. What it is the trader has been in the trade for 30, 45, 60 days. And he has held on to the trade, and every day he can't help himself but add a new little tweak into the trade. All right? So before you know it, after half the trade period is over, he's made it a really, really unnecessarily complicated strategy, which means when he has to exit this, it's going to be complicated. The more complicated you've made the strategy or the trade, the more it is going to be very difficult for you to exit it with anywhere near the profit that you had when you started exiting. You're going to experience more slippage because you've got to make more moves to get out of it. You're going to pay more commissions. And finally, you're going to take the risk of large numbers of execution errors. I've been in trades before I learned how to simplify things where I had to exit through 15 different executions to actually exit. It took me about an hour to plan this out, all right? If you have execution errors on even one or two of those 15 steps, it's going to be very tricky and complicated to rectify those steps in the middle of an execution. And so the simpler the execution, the better. A complicated execution requires extensive planning, and if you're unwinding a large complex position, then you're really taking a lot of risk. And so if the position gets too complex, what I advise this trader is, towards the end of the trading period, start to simplify it. There are techniques we can teach you where you can simplify the trade so that by the date you're actually exiting it, you only have 2 or 3 transactions instead of 15 in order to exit the trade. So keep it simple was my 8th piece of advice for this trader. The 9th is really, really huge, and that is the practicing of patience. Patience is critical in all forms of trading and in all phases of your trading career. You've got to have career patience. If you have a full-time job right now and you're just getting started trading, you can't quit your job right now. You've got to understand trading better, and you've got to have more screen time and experience trading better until you ultimately are in a position where you can trade full-time, either using your own capital or working for a prop firm like ours. All right? You've got to have patience with your learning process, and you can't take ridiculous career risks when you don't even know if you are a quality trader yet or not. Secondly, once you're trading, when you're in execution situations where it's time to make a trade, you've got to have patience. There's a certain price that is the right price for a strategy, and there's another price that's overpaying for it. You will normally get the opportunities to get approximately the right price if you have a little bit of patience. If you just jump in without having any idea of what's an appropriate price for your trade, you're not going to be very profitable. Pro traders are really, really good at being patient about execution. Sometimes they will take, I've seen guys take 3 days to get a fill on a strategy. If you have that kind of patience, you're likely to be successful. You've got to have patience with your learning curve. The fastest trader that's ever traded for us, that came to work for us, was trading for 6 months. That's the fastest I've ever seen. Okay? I've seen people take as long as 2 years before they get their stride, find their bread and butter trade, and start to trade successfully. So you've got to be patient with your learning curve, and you have to plan around a 6 to 24 month period where you're still learning to become a successful trader. And finally, and I cannot emphasize this enough, capital sizing patience. You've got to understand that you can't expose large amounts of capital to the market until you've been trading for a while, 12 months, 18 months, 24 months, because you may not have seen all of the things the market can do to your strategies in a short period of time. So if you have a lot of capital and all of a sudden something unexpected happens, you're in trouble, all right, with a lot of capital on the line because you were foolish and increased your capital too quickly. I'm begging you to increase your capital slowly. Plus, it gives you the ability to build your risk tolerance, which is a muscle that has to be built over time so that you don't freak out when you're down $10,000 on a trade, because it's the same as being down $1,000 before. All right? Capital sizing patience is completely critical. Please believe me on that. And I end it this way because this is a warning. It's funny, but it's also a warning. The first options mentor I ever had told me this one day: the market can do whatever the hell it wants to do whenever the hell it wants to. And if you don't believe me, look at the flash crash that happened in May of 2010, where there was nothing going on and suddenly, out of the blue, the market went wacko nuts. No one could figure out why, and the whole thing bounced back by the end of the day. All right? You could have been out playing golf, eating lunch or whatever, and that would have happened, and that could have been very costly. All right? So what does that mean? It means you have to plan for the worst case scenario. You've got to be ready for it. You've got to have exit orders in ready every day, whether it seems like a calm day or not, because you don't know. You don't know if something unexpected can happen. Options income strategies are built to win most of the time, meaning that if you leave your desk and you go out and you goof off for 4 hours, you're risking your livelihood by doing that if you don't have conditional orders in with your broker or some kind of preventive measure to make sure that if something unexpected happens, you are going to be able to address it promptly. The key to long-term success in options income trading is controlling the size of losses. Look, you're going to win most of the time. These are wide trades designed to have wins in lots and lots of different kinds of scenarios. All you have to do is not let your losses get out of control, and you should have a really, really good return. All right? But if you let your losses get out of control because you were sloppy, that's terrible. That's a lack of discipline. Honestly, it's a lack of character. And so you've got to control the size of losses. It's easily done if you take the precautions. So the technical key to long-term success in options income trading is being aware the market can do whatever the hell it wants to do, whenever the hell it wants to, and you have to be ready for it. Now, I'm truly hoping that you've taken this video seriously, and if you use a trading journal, you should consider really rewatching this video and taking notes. These are principles that I've developed from observing and teaching hundreds of traders for more than a decade, and the patterns distinguishing successful and unsuccessful traders are undeniable. If you want to trade for a hobby, then you can fool around and ignore this kind of advice. If you want to become a professional trader, a serious professional who treats this like the business that it is, then you do well to really think about and accept these ideas, internalize them so that you can set yourself up for long-term success as a professional trader, which is the kind of trader a firm like ours would want to entrust with our capital and back with our capital. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open the free registration page in a new window, so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now it's your turn. Take a look at each of the 10 points that I shared with my mentoring student, who's now, as I said, an extremely successful trader for us, and tell me which of those points is the one that you think you're struggling with the most. I'll try to briefly reply to each comment made, so go ahead and take advantage of this opportunity for me to provide you with a little bit of personal input to help you to grow as a trader. That's what gets us up in the morning at SMB. It's helping more and more traders to become successful and achieve their dreams.